In my video titled Sweet Spots for SPIA and DIA, I showed you how a deferred income annuity can be more powerful than a single premium immediate annuity at any given age. But I didn't fully explain why. It's because of something called compounding interest, also referred to as time value of money. And deferred annuities are actually known as the triple compounding instrument. So in this video, I'm going to talk to you about compounding interest and even show you an example of how it's calculated, in addition to explaining why deferred annuities are the triple compounding instrument. By the end of this video, I'll give you the facts so that you can make an informed decision about whether deferred annuities are the right fit for your retirement income planning needs. Hi, my name is Darlene Hartman. I'm a CPA and founder of D. Hartman Consulting, LLC. For the best retirement annuity advice, subscribe to my YouTube channel and be sure to hit that notification bell so that you can receive notices anytime I post a new video. I know. It's about time I used a picture of food on my thumbnail. I mean, this is a channel on retirement annuities. And wouldn't it make it a little more interesting, if not digestible, if I used a picture of food on my thumbnails? Well, before I get into how to compute compounding interest, I want to explain why deferred annuities are referred to as the triple compounding instrument. And I'm going to use the three main ingredients for an eclair to help explain. Those three ingredients are the pastry, the vanilla cream filling, and the chocolate glaze on top. So let's start off with the pastry. The pastry represents the deferral period for a deferred annuity. So during the deferral period, you're going to make contributions into that annuity contract, whether it be a lump sum amount or flexible payments. And those amounts will accumulate and cook during that deferral period until you start receiving those guaranteed income paychecks from your retirement annuity. So the longer the deferral period, the more benefits that you'll receive. So you may ask, how is that even possible? Well, it's due to compounding interest. So not only are you earning interest on the amount that you contributed into that annuity contract, you're also earning interest on interest. So as the balance continues to grow from year to year, so does the amount of interest that you earn on that retirement annuity from one period to the next. Now, I'm going to show you a calculation of how compounding interest is computed at the end of this video, so stay tuned. One of the primary annuity benefits is the fact that you don't have to pay taxes on that retirement annuity during the deferral period, but rather at the time that you start receiving those guaranteed income paychecks. Now, the vanilla cream filling on that eclair is represented by the money that you would have had to take out of your retirement annuity to pay taxes on the interest earned on an annual basis, but you don't have to because it is an annuity benefits. Now, by not having to take money out to pay taxes, you're keeping your contract amount intact and enabling yourself to earn even more interest on interest. Because again, you're not having to take out money from that contract to pay the taxes on interest, therefore resulting in a larger balance year over year to earn compounding interest. Now, keep in mind that if you're not having to pay taxes on your retirement annuity during the deferral period, then you're going to actually receive more guaranteed income benefits during the annuitization period, or also referred to as the payout period, when you start receiving those guaranteed income paychecks. Leave me a comment in the section below and let me know if me talking about an eclair is making you hungry for an eclair. Also, if you're enjoying this video, be sure to give me a thumbs up, subscribe to my YouTube channel, and hit that notification bell so that you can receive notices anytime I post a new video. Now, if you've been watching my videos, you can probably guess what the chocolate glaze on an eclair represents. Yep, it's those invaluable mortality credits. And the older you wait to start receiving those guaranteed income paychecks, the more mortality credits you're going to receive. Now, I can assure you that you're not going to pay anything extra for those mortality credits, but what I cannot assure you is that there's no extra calories hidden in that chocolate glaze. But you'll have to admit that that chocolate glaze is definitely the sweetener for an eclair, as are the mortality credits for a retirement annuity. As promised, let's go through a simple example of compounding interest. So I used an interest rate of 1%. I put a $10,000 lump sum payment into a deferred annuity, and then the deferral period is 5 years. Now, I want you to keep in mind that the compounding period can either be daily, monthly, quarterly, semi-annually, or annually. Now, daily would be the most favorable because you're earning interest on a daily basis. Unfortunately, deferred annuities only offer compounding periods of quarterly, semi-annually, and annually. To start with, let's look at compounding interest versus simple interest. So for simple interest, the interest rate and the average return are the same at 1% since there's no compounding. You will continue to earn 1% or $100 each year on the $10,000 if simple interest is used for the deferred annuity. Now, let's look at how to compound interest on an annual basis for a deferred annuity. You will notice from this example that the amount of interest earned in the first year is added to the beginning balance of $10,000 to compute the interest earned in the second year, therefore earning interest on interest. After compounding interest for 5 years, your average return is 5.1% as compared to the 1% interest rate. The shorter the compounding period and the more money that you put into that deferred annuity contract, the higher the average return and the ending balance, and therefore the more guaranteed income benefits that you're going to receive when you start receiving those income paychecks. Also bear in mind that the higher the interest rate, the more compounding interest you're going to receive. Now, if you made flexible payments into your deferred annuity rather than a lump sum payment, you're actually going to get less in compounding interest. So that goes back to the fact that $1 today is worth more than $1 tomorrow because of your ability to invest that dollar today. If you're wanting to obtain a triple compounding instrument or a deferred annuity for your retirement income planning needs, be sure to click the link below to apply to become my client. Also, if you enjoyed this video, be sure to give me a thumbs up, subscribe to my YouTube channel, and be sure to share with your family and friends. Thank you for watching. Let's get the conversation started on how to live your best retirement while not outliving your money.